Okay. Alrighty. Very long time no see. Okay. I gotta review my notes and then. So an IPO is an initial public offering, refers to the process of offering shares of a private corporation to the public in a new stock issuance for the first time. Okay. Private equity investment provides capital to companies with high growth potential in exchange for an equity stake. Equities market, also known as stock market, economies of scale are cost advantages reaped by companies when production becomes efficient. A company's calculation of the minimum return that would be necessary in order to justify undertaking a capital budgeting project such as building a new factory. A limited partnership in which one partner, known as the general partner, has all the power and most of the liability, and the other partners are silent but have a financial stake. Limited liability partnerships, flexible legal and tax entity that allows partners to benefit from the economies of scale by working together while also reducing their liability for the actions of other partners. Internal economies of scale happen when a company cuts costs internally so they're unique to that particular firm. Gotcha. Okay. Oh, oopsie. Okay. Is it capital N? Yeah. Okay. Let's delete as many of these as possible. It's basically the same thing. There's 1,000 companies that have IPOs. Ooh, apples. Apple stock's kind of nice. Maybe there is no recession, dude. Okay. Why are some shares priced higher than others? This might gum out. Stock splits and conversely a lack thereof. The majority of public companies opt to use stock splits at one point or another, increasing the number of shares outstanding by a certain factor, example by a factor of 2 in a 2-to-1 split, and decreasing their share price by the same factor. By doing so, a company can keep its shares at a price where it doesn't look too expensive to investors. Microsoft has split 9 times. God damn. Masterworks. Ugh. Okay. When a company increases the number of outstanding shares to boost this, although the number of shares outstanding increase, there is no change to the company's total market capitalization, as the price of each share will split as well. Okay, that's pretty easy about. That's okay, I'm good with that. Bloomberg US Aggregate Bond Index. The Bloomberg US Aggregate Bond Index, or the AG, market capitalization weighted bond market index representing intermediate term investment grade bonds traded in the United States. Investors frequently use the index as a stand-in for measuring the performance of the US bond market. In addition to investment grade corporate debt, the index tracks government debt, mortgage-backed securities and asset-backed securities to simulate the universe of investable bonds that meet certain criteria. In order to be included in the AG, bonds must be of investment grade, have an outstanding par value of at least 100 million, and have at least 1 year until maturity. Index funds are exchange-traded funds that are available The index has been maintained by Bloomberg since August 24th, 2016. Prior to then, it was known as the Barclays Capital Aggregate Bond and was maintained by Barclays. Oh, Barclays is a bank. See, I did not know this. Oh my God. Fixed income security is an investment that provides a return through fixed periodic interest payments and the eventual return of principal at maturity. Unlike variable income securities and the eventual return of principal at maturity, and underlying measures such as short-term interest rates, the returns of a fixed income security are known. They provide investors with let's just play this.
For a fixed income security, the periodic return on the investment is the same throughout the life of the security. Principal is returned at the time of maturity. The payment can be in the form of a coupon payment, a dividend on preferred stock, or an interest payment. The rate of return is fixed at the time the security is purchased. Thus, the investor knows exactly how much income he or she will earn from the security. Because of this certainty, fixed income securities usually have a lower rate of return than variable income securities. Fixed income securities are especially popular for risk-averse investors. Examples of fixed income securities are treasury bonds, certificates of deposit, and preferred stock with a stated dividend rate. For instance, an investor might own a 30-year treasury bond with a face amount of $1,000 and an interest rate of 4%. The investor can count on receiving $40 in annual interest payments for 30 years, at which time he or she will receive the final interest payment, plus the return of his $1,000 principal.
Gotcha, okay. I understand it. Okay.
Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are used to borrow money. For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. There are basically four primary categories of bonds sold in the markets: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the U.S. Treasury, and agency bonds issued by government-affiliated organizations such as Fannie Mae. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon rate, to bondholders, although bonds with variable interest rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments. And the maturity date is when the bond matures and the issuer pays the bond's face value. The bond market also tends to move inversely with interest rates. So bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall. In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
Okay. Yeah, we don't have to go too much into bonds because I don't plan on investing into bonds yet. The bond market, sure.
The bond market is a marketplace where investors buy bonds from either government entities or corporations. Bonds are issued on the primary market, which rolls out new debt, and the secondary market, where investors purchase existing debt via brokers or other third parties. There are multiple types of bonds. Corporate bonds usually provide a maturity of at least 1 year. They're normally used for financing current operations or opening up new facilities. National issued government bonds entice conservative buyers by paying out the face value on the agreed maturity date, while issuing periodic interest payments along the way. Proceeds are generally used to finance infrastructural improvements and to pay down debts. Municipal bonds, or muni bonds, are locally issued by states, cities, and other government-owned entities to fund various local projects. Mortgage-backed bonds, or MBS, consist of pooled mortgages on real estate properties. The investor is essentially lending money to home buyers through their lenders. Emerging market bonds are issued by governments and companies located in emerging market economies. And junk bonds are bonds that offer the highest returns but also present the greatest risks of default. The bond market offers distinct advantages. There are many issuers and bond types to choose from. Bondholders have preference over shareholders in the event of bankruptcy, and corporate and government bond markets are among the most liquid and active in the world. Of course, there are also disadvantages. Buying bonds directly is less accessible for ordinary investors. There's exposure to both credit and interest rate risk, and while bonds tend to be less volatile and more conservative than stock investments, they also have a lower expected rate of return.
These secondary market issuers may be packaged in the form of pension funds, mutual funds, and life insurance policies, among many other product structures. I think I'm gonna take this. Nah, dude, like, I'm not in the bond market though. Like, I'll never be, or maybe like when I'm like 50, bro, but I'm not gonna be in the bond market now. This is interesting. Okay. This is good. This is interesting, at least. Okay. This is like, I don't need that, man. is a pretty cool picture. Number of equity securities included. Yeah, but we already have this. And I don't need to go too much into the Wilshire. I'm assuming I've already gone to.
Equity has several meanings that vary by their context, but in general, each meaning refers to ownership. Equity is one of the three principal asset classes. The other two are fixed income and cash. Equity also applies to the value of securities in a margin account minus what an investor borrowed from a broker. But in general, equity is the value of a business or property after its debts and liabilities are paid. Think of equity as ownership in any asset after all debts stemming from that asset are paid. A car or a house with no outstanding debt is the owner's equity because she can sell them for cash. Stocks are considered equity as well. Sally's equity can be seen in different examples. She owns 100 shares of stock in ABC Corporation. That stock is her equity in or ownership of ABC. Sally has $75,000 worth of equity in her home. She owes $100,000 on it to the bank, but its current market value is $175,000.
Okay. This is important. Interesting, okay. Interesting. Okay, I understand that. Goofy ass head. Okay. Venture capitalist definition. Yeah, I don't need to know that much about venture capitalists. I feel like I've been doing this shit wrong, dude. Because I don't, like, I need to know a little bit. I don't even need to know a little bit, but it's good to know a little bit. Like, dude, in terms of personal finance, venture capitalists, like, maybe if I'm starting a business, but come on, man. I feel like I was a bit lost earlier. Right. where's the $525? Maybe it's an LC. Okay. So it's like, I get it. Okay, I don't need this stuff, dude. I don't need to know how to start a business because I'm not starting a business. Maybe when I start a business, I'll read up on how to start a business. Right now, I am a young little boy. I do not need to know how to start a business. Yeah, I understand that. Dude, next one is gonna be completely just Roth IRAs, dude. Next one. Trust me.
Tracking error is the difference between the return on a portfolio or fund and the benchmark it is expected to mirror or track. There are two ways to calculate the tracking error. The first is the easiest. Simply subtract the fund's return from the return of the index it is supposed to track. For instance, a mutual fund that is pegged to the S&P 500 had a 7% return for the year, whereas the S&P had an 8% return. The tracking error is 1%. The second way to calculate the tracking error is more complicated but more informative. This calculation involves taking the standard deviation of the difference in the fund's and index's returns over time. The formula is where n is equal to the number of periods, x equals the fund's return for each given period, and y equals the benchmark's return for each period. A low standard deviation means the fund tracks the benchmark fairly closely. A higher standard deviation means the fund does not track its benchmark very well. These figures indicate how well a fund is managed. Investors seeking a fund that accurately tracks their preferred index should look for funds with low
Okay. There's no way I need that. Okay, that makes sense. I think I'm gonna call it here because I cannot. Because I cannot do this anymore.